We're going to bring in Chad Slater, who joins us from Morphic Asset Management. And Chad, we have certainly seen a pullback in commodities prices. Just last year was a huge rally, but they seem to be falling back, seem to be drifting back into the old days of falling prices there. What do you think is driving it at the moment?
Yes, good afternoon. One of the interesting things I think is happening is we're slowly going about drifting, as you say, back to the bad old days where everyone has their own story, whether it be iron ore, for example, there's excess supply there. We look at oil and we're talking about so non-OPEC and even some of the non-main OPEC suppliers like Libya bringing on supply. But when you add them all up and you look at broader indices of commodities, we can see they're all drifting lower. And I think what's happening here is the Chinese growth at the margin has decelerated there, and you're seeing some signs that the amount of credit they extend is slowing at the moment.
So what do we need to see in order to, I guess, revive this demand? As you say, it very much seems to be a supply story at the moment. What do we need to revive that demand side?
Look, unfortunately, I don't have much good news there. That it would seem the Chinese government is quite happy with where they're at. If we rewind maybe 12 to 18 months, the Chinese government became increasingly concerned with the state of play of the economy. And they went about inputting a lot of stimulus and credit growth and infrastructure into the system. I think they're very happy with where it's running at the moment. If anything, at the margin, they'd rather push against the wind, so to speak, to try and decelerate things. So, unfortunately, I don't see a great deal of extra demand coming through in the short term.
We just heard that news, well, just speaking of China, the US MSCI index has added China's A shares to its emerging market index after sort of getting knocked back for the last 3 years. Does this really show sort of, that investors are confident in its financial markets?
Look, the Chinese stock market, it's an interesting story in so many different levels. One thing that they had was an issue about 12 to 18 months ago, going back to this deceleration, where they had a bit of a mini bubble, or you might even want to call it a major bubble, which popped. And I think a lot of the people on the ground that got involved were angry at the government. And so the government there is wanting what we call a slow bull market. I think they're quite happy. If you look at the Shanghai Composite now, it's trading up this year on the expectation of this MSCI inclusion, as you mentioned. I think Chinese government's quite happy with that. Unfortunately, I think at the margin, as I mentioned before, the infrastructure spend, Australia's more exposed to that sort of spend rather than it is to local consumption stories.
So how are you positioned for that emerging market exposure across Asia?
Yep. Look, as some of your viewers may be aware, over the last 6 or 9 months, we've expressed how we've been long India in particular, long Pakistan. In general, we've been quite constructive on emerging markets this year. But what's happened, I think, here with emerging markets up about 18% year to date, if you compare that to, say, the Aussie stock market, which is up 2%, it's been a fantastic year for emerging markets. And we think, that sometimes it's better to travel than arrive. What we mean by that is at the margins, we're probably taking a little bit out of EM. We think, the best, whilst it'll still be a good year, the best bits have probably been done for now. So we're looking to reallocate a little bit towards places like Japan.
Yeah, right. And is that any expectation around currencies? Because we know the Japanese market is obviously closely correlated with moves in the yen. Does that play a part in your view, in terms of that allocation to Japan?
Yeah, it's a good question. Traditionally, most people think that when the yen goes down, i.e. the currency weakens, stock market goes up because it's a predominantly export-driven economy. And that's been right for the better part of 3 to 4 years. What's been quite fascinating about Japan this year is the yen has strengthened over the course of this year, yet the stock market's gone back to its highs. So there's actually been quite a good decoupling, which no one's talking about. So furthermore, we actually think the currency will weaken, as you mentioned before. But its resilience in the face of strength suggests that if the currency does weaken, we actually think it could be quite an explosive move to the upside.
Yeah, right. Speaking of sort of currency conundrums or dilemmas at the moment, the Aussie dollar, I don't know what's going on here because it's just remaining so strong around that 76 mark against that backdrop, as we were mentioning there, of falling commodities. What are you making of those moves? Because obviously it's coming back to that greenback story, but it certainly would be a dilemma for our Reserve Bank at the moment.
Yes, I must say we haven't called this one particularly well this year. We thought the Aussie dollar would weaken on the back of weaker commodity prices, and as you said, it's quite remarkable it's trading up here at 76 cents. And if we look back of what didn't work out how we thought, essentially the US markets, as bond yields have fallen, a lot of people were saying we should buy the US, bond yields are going to be higher than everywhere else in the world, US dollar strength. So as the bond yields there have come back, the gap between US bond yields and Australian bond yields has compressed. So people have been much more happy this year to hold the Aussie dollar, for example. And they also tend to often hold it as an EM proxy. So we didn't really call that one particularly well. Where to from here? We think if the commodities keep going at some point, like oil below 44 towards $40, has got to lead through towards Aussie dollar weakness. And also, as you touched on, the RBA, if we get towards 80 cents, this puts the RBA in a really tight position as well. So net, we probably think it goes lower, but that said, it hasn't been a great year for calling it for us.
Yeah, it really hasn't. Obviously, coming down to Federal Reserve rate hikes as well, although interesting moves there coming into that rate hike. We did see the greenback kind of weakening, so it seems to be treading water at the moment. I think the market's a little confused as to what's happening. Do you think the market's sort of not pricing in or not believing in the Fed's next move, whether we will in fact see a rate hike towards the end of the year?
Yeah, the market's really split on this now. The Fed has a history in the last 2 years or 3 years of talking a story and never actually ending up doing it. So the market is quite right to be sceptical. They've gone twice this year. The market's got the feeling that they're going to struggle to do a third or the balance sheet, so they're going to struggle to do both things by year end. And so what's really happening, or the most interesting thing is, the market's begrudgingly conceded, yes, they have done a couple this year and they might do another one, but the back end, the 30-year yields, has been rallying very hard. So the market's going, you know what, we'll give you your hikes if you wanted them, but we're telling you you're probably going to overdo it. So the curve's been flattening a lot at the moment. And last night saw a big breakdown in the 530 spread. So the market's really saying, yeah, we'll give you a bit more if you need to there, but we actually think you're probably getting towards the end of this hike cycle.
All right, fantastic. Chad, we're going to leave it there. We appreciate you joining us. It's been great having you on. Thank you.
Cheers, thanks.